This is Morten Reitert from English TV, and as I promised on my post on LinkedIn a couple of days ago, we have decided to use this holiday season to bring some perspectives on mergers and acquisitions. And basically, we sent out an invite on LinkedIn to see if any people took the bite. And the first person that was I'm so fortunate to be with today is Sean Kavanagh from Canada and Toronto. And welcome to this little episode, Sean. So how are you today?
Doing very well. Thank you very much for inviting me.
Sean, you're obviously not directly involved or involved at all with the printing industry. Can you tell a little bit about what you do for a living and your background?
What I do for a living is I'm a mergers and acquisitions M&A advisor. I've had specific experience within the printing industry. Actually, my father was a printer, and we had our own print shop and newspapers, and so I'm familiar with the process. I've had many clients that have been printers, and did acquisitions within that printing industry itself. But mostly I'm small business, private company focused and not public company focused. So I do most of my work within that realm, with throughout many industries, not just printing.
I assume that when you work with companies, I think take that a lot of these companies, when you talk mergers and acquisitions, are owner companies, self-owner companies. And I was thinking that sometimes I could imagine that people that have worked in a company for maybe decades, they have a different opinion about the value of the company than the ones that are going to buy it. Is that a right assumption?
Yeah, it's a huge assumption. And we call this the valuation or expectation gap between owner-managed companies and maybe more established medium or mid-term companies that have the owner maybe backed away from the operations or daily operations of the business. You are going to get a different valuation for that. And I've written about this, I've blogged about this, I have a book about this, and it really is important for the owner manager to understand how the valuation process works and not necessarily compare it to a public market transaction, but more compare it to another owner managed situation within any other industry.
And when people get to a company and a person like yourself, is that typically on the buyer side or on the seller side, or is that both sides?
It's the both sides. I can work the buy side and the sell side. I would suggest that most of the work for businesses have to be done on the sell side, primarily because anyone on the buy side is typically a little bit more experienced, and it's not their first rodeo, so they know how to go in, buy a business, build a business, etc. Where many companies, even larger companies, this is the first transaction they'd ever had, and they've never been through the process before. And it can be a scary process, and it can be a process in which they have a lot of anxiety because a lot of things fall out of their control. And to go forward in that process, it's always better to have someone to hold your hand with you in order to give you confidence that what you're doing is correct.
And I would also assume that as a professional like yourself, you are not emotionally attached to a company the same way. So you have maybe more a neutral perspective of the business, right?
Well, notwithstanding that I care about my clients and want the best for them, obviously. But there is a sort of a detachment where this is not my baby walking down the aisle. And so I give that, or anyone would give that independent approach, satisfying the goals and objectives of the client, but at the same time trying to hack away the brush of emotion that we're trying to walk through.
And when you get into let's say that let's play the game. Let's say that I want to sell a company. How do I get started? I mean, do I call my auditor or call my lawyer, or I mean, is there a typical process for this, or is that different from every acquisition that you have been involved with?
I would say the first person you would contact would be someone who's going to advise you through the process.
Mm.
Um,
Is that a typical
the
like a
problem,
guy like yourself?
exactly.
Yeah.
Uh, and I'll tell you this, it's obviously, this sounds self-serving, but a lot of times businesses are not ready for sale.
Yeah.
So you can have a business that makes a few $1 billion of profit every year, does really good, has good clients, but it's still not marketable for a lot of different reasons. And to get some businesses to marketability, sometimes it can take 2, 3, 4 years. So typically what happens with me is that someone will contact me. I'll get referred to by an accountant or a lawyer or someone else that they've approached, or their client has approached them about selling, but want to have someone to go through the process with them. Well, I will go in there, do my sort of due diligence on their side, and see that, well, you're not ready to sell for a couple of years unless you want to sell for a low price and have a huge earnout. So many structures are between, I'll pay you cash for your business, or I'll pay you some cash and then pay you a yearly amount for the next few years. So what I try to do, and what a good M&A advisor would try to do, is get the company in the position to be able to sell for cash. So if we can equate this to a home sale, I would go in, help do some renovations to the kitchen, the bathroom, do some staging. So when that couple comes in to buy the house, boom, they want it right away and they will pay over market.
Mm.
So but sometimes that renovation and remodeling and do some stuff might take a few years.
Mm.
But the thing about it is, if that kitchen and that bathroom are not done, and it seems like there's a lot of work to do, well, that couple will not even buy the house. They'll just move on.
Mm.
So that marketability of a business is something that not a lot of small businesses are really focused on. They think, I make profit, I'm valuable. Well, no, making money is not the most important factor on the valuation and marketability of a business.
Is that because, I mean, even if you have like a profit year over year, basically that mean the reason why you say this is it because it sometimes is difficult to convert your business into another entity and just assume that you will have the same profit?
Well, you have to remember, when someone's buying your business, whether it's a strategic purchaser or whether it's a financial purchaser, they're buying your business as an organization or an operational money-making machine. They want to be able to plug your business into what they have, and it hits the ground running, making money. So a lot of times, in the printing business, let's say you have a lot of operating capacity but no sales. So somebody sales, you have some presses that I'm waiting for 2 years from Heidelberg, let's say, I can buy them off you right now. Okay, so even though you don't have any sales, and I've actually been through this process before of acquiring some companies that had big 6-color or 6-stage Heidelberg presses, they were actually had to wait a long time for it. We had the sales, they had the machine. We just bought the company. Now, it hadn't made money, but we bought it for the assets. So there's a lot of reasons why a company buys it. Facebook bought WhatsApp for $22 billion, and it was losing $250 million a quarter. So it's whatever your business can add value to somebody else's is how you're going to get paid.
What I like about what you're saying is basically, if I interpret what you say correctly, is basically that if you make a quick sale, of course your price will be lower than if you do a planned sale where you kind of adopt the two businesses to, and maybe you don't know the buyer, but as a mergers and acquisitions specialist, you know what they're looking for, like synergies and for efficiency, and cut off the things that are not needed, and that is what you do, right?
For sure. Synergies are fairly easy to see if you're one printing company is buying another printing company. But for example, if your printing company has 3 major clients, okay, although you make money, you're not diversified in your client base. So what I've run into a few times on the buy side, and one thing M&A is very dispassionate Shark Tank. So when we tried to offer, for example, what we thought was good value to a company to buy there, because we were interested in getting their clients, not necessarily their operating capacity. So they had some good contracts, and and they good business. I'm not saying there's anything wrong with business, but they wanted too much money, right? So what we did is we planned a strategy to take over their client base.
So that again depends a little bit on whether you're on the buyer side, on the seller side, depending on what role you have to take on in this, right?
On the seller side, I would say, look, you're very vulnerable in a transaction because you only have 3 clients.
Yeah.
Right. We do have to work over the next couple of years where we diversify our client base and therefore have a far more robust offering for someone. So we don't have to go to a strategic buyer. We can maybe go to a financial buyer and says, look, this is what we got, some good clients, well established in the market. We can actually hit the ground running as an entry into this market. And therefore it opens up a far more robust marketing potential with much more different clients or much more potential purchasers than just your strategic ones. So again, your business is the same, making the same money, but the way you package it for sale is going to determine what the value of it is, how much you're going to get paid, when, and whether someone might develop another strategy to maybe compete against you. Because remember, when you go into an M&A transaction, they give you a letter of intent as a type of process. You release information to them. If that's your competitor, your competitor is coming in and looking under your skirt. And so if they find, okay, you know what? We don't want to buy the business. Maybe we know how to compete with the business, right? So it's a very risky process, and you got to make sure you know what you're doing. So
I can't help think about, because I think you said in just a few moments ago that often the seller is not really ready to get the sales done when he's, for example, approached by something. But with the long process that you describes here, it sounds like that if you want to do like a generation shift, or you want to sell your business for other reasons, that this is something that you need to plan well ahead. In your opinion, is the measures that you just described, I know that you said that you're a specialist in small and medium-sized companies, but do you think that the measures that we just spoke about are the same when it comes to, for example, M&As with the public companies?
Well, where we get into the public companies and the larger private companies, which arguably are not much different, is that the larger companies will have already done and worked on the that have already did, right? So for example, one of the things that you do for due diligence is we would like to see what your projected income is in the future. Okay.
Yep.
Now, if a lot of clients I come to, well, I've never done any projections before. I said, okay, that's fine, no problem. Let me look at your budgets and how you budgeted things and compared your budgets to actuals. They said, well, I don't do that, and I go, okay, that's going to be tough. Because what people, if you're projecting your income for the future, the only thing to rely on for a purchaser is how accurate your budgets were in the past.
Yeah, that makes
right?
sense.
So if I want to look at your 5-year budget and realize, you're pretty good at budgeting, and no budget equals actual. That never happened. But if your budgets are pretty close to your actuals, and you don't have much of a variance, and now I can project, I can believe and put faith in your projections. But if you've never done a budget, if you've never done a variance analysis, how can I do your projections? Now you go into mid-sized companies, and part of the CFO's role is get the director of finance to do budgeting and analysis and all this stuff as a normal course of business.
Of course, yeah.
Smaller companies don't do that. So when I go in, what happens is that, and just as a conversation piece right now, if I go in and ask 15 questions of you in my due diligence process, and you hit every one of these questions out of the park, and basically all my questions are to determine the risk of your business, right? And so if you say, I've done budget analysis, I've diversified my client base, the owner, there's senior management that's in place in between the owner and the operations of the business. I have great bank financing. The owner has set up his estate on a tax preferred basis when they do sell, and all around the world there's different types of tax regimes for selling businesses. Okay, a lot of people would understand capital gains versus income. I believe in the Commonwealth countries anyway. And so they've already set up their state. They got the banks, so all those things that I just mentioned. Well, that company has been preparing, and all of that takes multiple years to do. That company's been preparing for sale. Now you go to another company that, let's say the financial statements look pretty close to the same, but they haven't done any diversification. They don't have owner management. They don't have a banking facility. They don't have all these other same factors. And then they can't provide any budget analysis or any type of interpretive information. Mm-hmm. Well, then you're asking questions. One company, I don't have to worry about stuff I didn't ask because I know it's pretty much done. The other company, they can't answer any other questions. How much more do they have going wrong that I can't even ask about? Mm-hmm. So now in a position where, like, for a lot of companies, it's not the quantitative factors that throw them off the buying table. It's these qualitative factors that no lawyer and accountant is going to say, look, you can't buy the company. I can't advise you to buy this company because there's too many things I don't know about it. Could be
And of course, if you're in a position where let's say that you are a public company that wants to buy a private company, then this can be an even more delicate case, because the public company knows exactly the figures and what they need, and also if they sell, what they get rid of, so to speak, right? And the buyer one, they need to get advices from companies like you as specialists in merchant acquisition. But let's say that the buying company has limited accountability in sense of books and financial stability and these kind of things. Is that something that you see from time to time as well?
The lack of transparency from the buying company?
Yeah.
Yeah. Well, that's on. Now we're flipping over to the sell side.
Yeah, so I'm asking because I do understand what you say about these things, but I'm a little bit curious in sense of, as you said also in the beginning, it's like if every transaction has a buyer and a selling side, of course. Right. And I understand that if you are a consultant for either, then you're not for the other part, of course. But I was just wondering if the methodologies for what you just said about the way that you build up the company, that you get the 15 measures on where you have like the bullet points. I would assume that this is the same questions you would raise on the other side of the fence if you had a mergers and acquisitions guy from that side as well.
Well, yeah, for the buy side, there's a lot less onerous disclosure because what does the seller care about what the business of the buy side? Yeah. Where the seller's concerned is, says, do you actually have the money?
Yeah, and that is because like first, before I get off the bat, how do I know you even have money, right? And how would you normally, let's say that you have a printing company A and a printing company B, and they have decided to go into an acquisition process. How would you normally? I mean, there's two sides to it. One thing is, of course, the valuation of the companies. Another thing is, of course, also how it's going to be paid. Is it an earn-out, or is it a cash deal, or is it a process where you can plan the paying of your asset over some time? But is that the same? That procedure itself, is that the same for a public and a private company, or is that also different from company to company?
It's the private or public company is not really any difference, because we're really getting into the substance of the deal. Yeah. So much of the work on the due diligence of the purchaser, whether they have money or the intent or anything like that, in my experience, I work with the lawyers to do most of that type of due diligence. They can go in and ask the banks, does this guy have a credit facility big enough to buy us? Right? Because lawyers deal in the confidence end of the market.
Yeah.
Not that we can't do that, but I mean, as a division of duties for an acquisition team, that would be how I work with the lawyers. They go in and verify the legitimacy of the buyer. When it comes to purchasing, if the buyer is a public company, they have more exposure from the board of director level to shareholders. So they are less likely to acquire a company that doesn't have an amazing amount of disclosure capability.
Yeah. They need to,
just
right?
They might have. Well, they might have their own sort of guidelines. We can throw in, environmental or social responsibility type of things they want to wrap around themselves in terms of acquisition, where a private company doesn't have that, right? Or may not want it. They don't have it, but a regulated company or a public company has a lot more constraints and eyeballs on them. So they're going to be a lot more conservative. Right. And on the flip side, on the sell side, if public companies do get taken over, there's a big fight going on between a Canadian company and an English company right now, Cinemax and Cineplex. Right. The COVID, they were in the middle of a acquisition, then COVID hit, and all the theaters are closed down. So that's
so the value changed overnight, right? You can say.
Well, that's what happens, right? Sometimes that's what happens. But with respect to the due diligence, it's still heavy due diligence on both sides, whether it's a private company or a public company. Well,
sorry.
There's no difference in process, but public companies tend to do a lot more on the buy and on the sell side. Right.
When we look at one thing is the process, and I do understand what you say here, and I hope our viewers will understand that as well. One question, however, is that when you look at the valuation of a company, because I mean, one thing is that you can prepare, as you just talked about before, that the price can be more attractive for the seller because you prepare the sales, right?
Right.
But another thing is that when you're going to decide on a price, I take that even though you say there's other things that the profit in the company that comes to measure, I take that profit still has saying in because eventually the buying side needs to pay for the asset, and normally you will probably depreciate your investment over a certain period of time, right?
Yes, but very, very high level. A valuation is basically, there's two elements of it. One is the straight on luck valuation, where I take the income and discount it at a risk rate. Okay. So if this is a common term in England, 3 times EBITDA or 4 times EBITDA. Okay. If people say to me, I want 5 times EBITDA, of course you would want, because it's 5 times. Why wouldn't you want 12? But I said, do you even know what 5 or 12 or 4 or 5 or 7 even represent? The concept of that 4 or 5, if you inverse it, a 25% required rate of return is actually a 4 times multiplier. So what they're saying is that the risk of your business requires me to charge you 25% return. I need a 25% return on your business to give you a 4 times multiplier. So what I do in my practice is that I try to get that 3 or 4 to a 7 or 8. So if you have $1 million income business, you can have it worth $3 million right now by yourself, or you can employ someone like me that'll help you grow it and growth and marketability as well, 6 or 7, and now you have a $7 million company, and you same revenue and income. So what the due diligence does is starts out at 3 and gives me a reason why I should pay 7. So that determines my range of values I'll buy this company for. So now we look at this and say, okay, you know what? This is a rock star company. Okay. It has 50% margins. The rest of the industry has 30% margins. So although it only makes $1 million of income, it's working at 20% capacity. I can buy this, fill up the whole capacity, and now that company's worth or sorry, it's making $8 million. So I'll pay $7 million for it. And now it's worth $56 million to me because I can fill the top line. But why can they do that? Because your business operates efficiently. Yeah. There's no risk to the business. Yeah. I can just put a revenue in there and it turns out profit. But if you have all these other risk factors in there that prevent that from happening, you're going to be down into the lower quartile of valuation. So it's really not about how much profit you make, is how efficient you are in turning revenue into cash flow. That's what you have to focus on for your business.
It's quite interesting because when I went to, we have like, maybe you know that from your father's time in the printing industry, but we have this one big exhibition, Drupa, every fourth year, which has unfortunately been cancelled because of the COVID, of course. But at the last Drupa, I made an interview with a banker from AKF, which is a banker that has a department that is financing printing machines. And the interview was quite interesting from my perspective, because one thing is I don't know much about financing in general, but also because I found it interesting because he said that sometimes we finance more on the idea and the team that sets the agenda, rather than just the balance sheet, because basically the balance sheet is a mirror of the past, where your new team and your ideas for the future is where you're going to actually pay back. And it sounds similar to what you just said right now.
Well, bankers are really, and I don't know the banking relationships in Europe. I think they're pretty conservative, like they are in Canada, and not as conservative like they are in the States. But they're looking at all these private equity companies and venture companies just making so much money, and what they're starting to realize is, you know what, I get paid out of the earnings they make, not on the balance sheet they had.
Yeah.
And so I'm really just understanding this. But most people have to remember, most banks are not in the risk business. They're in the margin business. They borrow it to, lend it for, and try to have no default. So they're meant to provide liquidity to the market, not necessarily business financing to people. Now they do both, but remember where their focus is. They want to get their money back. So, but now we don't have any bricks and mortars. It's just, it's all zeros and ones now. And I've even this year have 6 deals with Canadian chartered banks that financed pre-revenue software companies with conventional financing.
Wow.
At 5.5%. Because I go, like, what else are you lending on? You're not lending on a restaurant, right? You got to make some money. And the only thing that makes money nowadays is tech.
Yeah.
So you either get on board or you get thrown overboard.
Yeah.
And so they're figuring it out. But what that happens, and I want to make what's specifically germane, is that now they're focusing on the execution ability of management, right, as well as the business model and business plan. So what I do in my work is that if somebody comes to me and says, I need some financing, I said, let me see who's your team. And I said, before you submit the loan application, we need a couple more people on your team. Yeah. Now they can just be advisors; they don't have to be paid. But if you have a sort of a 6-prong execution strategy, you need to make sure you have rock stars in every one of those positions.
Of course.
If you don't, your execution is not going to get done. So banks will finance in your ability to execute your strategy, right? As well as their belief in your business plan or your product. So they're getting on board, and they realize when they do this that their loan losses go way down, and then they actually do get in the higher raises. They're getting more comfortable with residual income programs like license fees for software. They really like that because now they can match
the recurring revenues, right? Yeah,
absolutely. And they're getting it. A little late to the game, but they always are. They're always conservative, and we want our banks to be conservative. Right? The backbone of our financial, our financial industry. But at the same time, they got to keep up with the economy as well, especially now with COVID. Everything's being shut down. Everything is going digital. Everything's going remote. And so they have to get on board with the new economy, because generally banks as a whole represent the economy.
Yeah.
Right. Large diversified banks represent the economy.
And I take also that since most banks are not just corporate banks, but also backed by, regular people, that's why they need to be a little bit more conservative in order to protect the values of the families, of course, right? Sean, we have already been talking for half an hour, so times fly by. That's fantastic, right? One of the questions you asked me to prepare some questions just so we had like a kind of a talk track, and one of the things that I asked you was, let's assume that we go back a little bit to what you spoke about before, but let's say that now a buyer and a seller are in a process, and you have come to an agreement with a seller that you're going to represent them and help them beautify their business, right? And I was just wondering, when you do that and that process starts, as you said, that even though you sign an NDA, you still give information that is the backbone of your company and all the secrecies you need to reveal at some point. What is the status for such a procedure if it's interrupted for whatever reason? It could be a COVID, or it could be bankruptcies. It could be like things that you have not under control. What happens then?
So you're in the middle of a due diligence process, and there's some sort of event that happens.
Yeah.
Well, so typically what happens is that you will hopefully retain me way before you even think about selling your business. But let's say you do it after the letter of intent stage. So you met someone, you're starting evaluating your opportunity, start doing your negotiation at a very high level, owner to owner type thing, right? Yeah. Or decision maker, and they say, okay, let's do it. This is the price I want to pay. Let's start our due diligence. And we start going through this process. Well, what happens if there is a shock event, or there is some sort of catastrophic event? Well, then you both agree on just taking a pause and letting that flush out. But typically, even in the letter of intent stage, which letter of intent is not binding, it makes reference. A good letter of intent drafted by a good lawyer would make reference to what we do in that circumstances where things get disrupted.
Like right? You have force majeure situations in normal trade that is similar to that one.
Yeah. It doesn't have to end the process, but we have to sort of regroup. No one, if something happens, both sides have an interest in letting the dust settle before they make any further decisions, right? Yeah. This is real money.
Yeah.
So
and lives for people that works there, right?
Well, for sure, and you would be surprised how, especially in the small to mid-sized business, that's an overreaching concern.
Yeah.
That these people have it's a huge, immense responsibility. I am myself employed about 11 people, okay. and I'm always thinking, especially around Christmas time, to make payroll.
Yeah.
Right. And I realize that, wow, this is, you really have a responsibility to get your business done and support your people. And when you sell it, these depending on how big, but even a 50, 60 man company, the owner manager is going to know every one of these people. They were involved in the hiring of probably most of these people.
Yeah.
Haven't known them for years. And then they're friends, and they're like, sometimes you leave, and even though you're the owner, your best golf mate is the guy that works the machine on the factory floor,
yeah.
Right? you want to protect these guys and make sure you make good decisions for your staff, and the buyer wants that too. Because remember, smart buyers are buying the revenue to profit machine.
Yeah,
they want to take care of all their human resources as well.
Yeah.
Right.
In your experience, is that like one thing is that as a seller you want to secure your employees, as you just mentioned, but is it also, in your opinion, often that the buyer have a similar interest, not just because of continuity in the business, but also because of human? I mean, especially when you talk smaller and mid-sized companies, I think that the personal perspective is a deep concern, right?
Yeah, and HR is very, very important, and in Canada, and I'm sure in the UK, human rights legislation, all this sort of comes into play. Now, it's not fair. Being an accountant, I can say this is not fair, but the accounting heads getting chopped off for synergy is an accepted reality, right? We don't,
because you don't need two accounting systems, for example, right? Yeah.
No, accounting is very, very scalable. So there is an understanding if a larger operating company is buying a smaller operating company, their heads are going to roll somewhere, right? But most of the time when you're paying for a business and a premium business, you're paying for the other operational value that's coming in there. People that have been hired, that have been trained, that understand the process, that already have the team culture around the environment. That's another thing I didn't mention before. So we do due diligence. How's the team like? How do the people get along? Right? You know, there are fractions within the team that are causing problems we don't know about. And so that's what you're buying. You're buying that ecosystem to use, right? And what's happening more and more, and if you would hear the stats, companies that purchase the integration of the two cultures usually fail.
Yeah,
because you're just sending in a bunch of bean counters like me with no awareness of
how should you know?
Side.
Yeah.
Well, first, they don't pay you for it, right? They don't. They're
fair enough.
They don't want to pay you where they don't need. No. But it's very important on the buy side for me to understand who your people are and sort of get an idea. Not that I'm a psychologist or anything, but how adaptable those two cultures are. Do we want to keep them together, or put them together, or maybe keep them apart? Right? But as far as that goes.
I think that, to some extent, that when people fear mergers and acquisition from an employee's perspective, I think it's often because they see that very often it's a matter of headcount. And often I think that the company that is being sold is one where I think a lot of people seem that, okay, maybe they are the ones that loses their job first because people don't know each other, right? It's easier to fire somebody you don't know rather than somebody that have worked in your company for 20 years. So I think that is one of the fears that some people have about M&As.
That is a justified fear. Okay. Like I say, especially for the accounting department, because you're gone. Yeah. There's not even a question mark there. But for the operational people, the only thing I can say is that if you're extremely valuable to that company, you're going to be extremely valuable to the next company.
Of course.
Because when you're buying a company, what you're trying to really do is buy revenue capacity.
Yeah.
Okay. So unless you got some sort of special intellectual property or process or something that's going on, typically I'm buying you to triple my sales. So there's never really an intent on the operational side, in most cases I've been involved with, to eradicate operational people, right? Because the value of the business is the people.
Yeah.
If I was going to fire all the people, we would take a different strategy, like I mentioned before. I'll just go buy the machineries and try and poach the clients.
But right? I can't help think. Yeah, I can't help think about, because since the financial crisis in 2008 and 2009, I think that if we look at the printing industry in particular, I think that the overcapacity in the industry have been one of the factors of mergers and acquisitions, and that has been on the opposite, because you don't really buy the staff or the equipment, you only buy the clients, and it seems to be a faster way to achieve your objective with volume rather than trying to stick to both machinery and people. So that of course depends whether you are acquiring a profitable company or a suffering company or what kind of industry you're working in, right?
Right. And when you look at the printing industry, and again, I'm looking from a North American standpoint, the average over the last 10 years, and there's been a lot of consolidation, especially in and around Toronto in this industry. I know I was part of it. That the average right now, the average business is about $5 million in revenue with a 55-year-old, 60-year-old owner. And $5 million in revenue is not a lot of revenue. And so there's a lot of companies that are just trying to sell. They can't sell. So they're just sort of giving up and converting their business into a job for a while by the purchaser. So they're not even getting anything out of it. and that's exactly what I've been alluded to before. These people try to go to market and realize their business isn't worth anything.
Yeah,
it's just not. You have a job. You're an incorporated company. You have a job.
Yeah.
And the better thing would have been to do 6 years ago, get 5 of your buddies to emerge, right? Have a $30 million company, right? And get paid $45 million for it.
Yeah.
But who wants to spend 10 grand a month on a guy who could do that for you, right?
Yeah. That's a ever recurring question. Sean, final question, and maybe you can't answer that, but I will ask it anyway. Let's say that we have done the deal, we have signed the papers, we are ready to rock, and then I don't pay you. Then what? Not you, but, but the buyer is not paying the seller. What happens, and what is? I mean, is there like a loophole for getting the deal turned back to the previous owner, or how do you get on with that situation?
You mean me as a advisor not get paid, or
no, you get your money. Don't worry. I'm more talking about this. The let's say that the guy that wants to buy your company, he either don't have the money or he will not pay them or whatever. Right? What is the situation then?
That's never happened to me. Or any of the deals I've been in, because and I alluded to this earlier. We're gonna get myself and the lawyer together and find out who this guy is trying to buy, right?
So you secure that the money is available before you get to any situation like that.
Make sure his money's in escrow with his lawyer, right? We got the deal. We put all the funds in escrow. If he doesn't pay,
even if it's is that even if it's a period of, let's say, 2-3 years, as you said, starting the process of getting things going, is that still like something that an escrow is using? Or other kinds of
the process should not be for an acquisition should not take longer than 6 months.
Okay.
So my process of getting involved might be a few years to renovate that bathroom and and a few rooms in the attic. So my experience might be there longer, but once we're ready to fire and get that letter of intent by 6 months, and who we like, we have the power of exposing who we want to know that we are for sale.
Yeah.
So as we're taking this to the market, we get to pick and choose. So a good advisor will say, 3 years ago, I would say to you, who do you think is the best, has the most money to pay you cash right now for your business? Who do you think, whether it's a strategic buyer or somebody else, who would be that person, right? And so what I would do 3 years ago is I'd go back and sort of test out the market and say, are you guys acquiring? What are you acquiring? What, if you're going to acquire a printing business in 3 years, what would that business look like? What would you pay the top dollar for? What do you need? And this guy would tell me, and I'd go back to my client and says, okay, this is what we got to build, because this is what this guy wants for 3 years, right? Mm-hmm. And then we're going to build that. And if that guy wants something like that, then there's probably 3 or 4 other people that would want something like that as well, right?
So unless the price is totally unacceptable or for some reason evaluated totally wrong, there should be other people in the market willing to buy that asset, basically.
Depends. Like I said, if you get me involved 3 years ago, there's going to be people competing for your business. If you just take it to market without any preparation, there might not be any.
Yeah.
So, and then there's the difference between zero and multitudes. And if there's 3 or 4 and they're sort of hemming and hawing and saying like, you know what, I don't know, then all of a sudden demand goes down and therefore your price goes down. So it's very, very strategic. In the sense of who we're going to attract to the party. Now, what I like to do is I like to compare the shares of your company with your product. So you're making a new product. What do you do before you put it to market? You test it. You go to people and say, do you like this? What do you like about it? What do you don't like about it? Or if it's a user interface on your you're doing some sort of user interface with a computer, your computer software, you go ask people. So what do you think? How would I do it? Well, why wouldn't you do that for your own company when you sell the shares?
Yeah.
Why would you go and try to spend 6 months a year to find out who wants to buy my company? What does the company have to look like? What do I have to change for it? Right. And then wrap it up in a big bow and say, who wants to look at it?
Hmm.
It's really confusing. I just want to add on. We buy a house and hopefully it goes up in value and sells. We buy investments. We hope it goes up in value and sells. Now, investments might pay us some dividends or some cash and stuff, but really we're in there for the capital gain. Buy artwork, same thing. We buy other real estate, cottages, apartments, buy low, sell high, buy low, sell high. The only place we don't do that is in the most controllable asset we have, which is our business.
Yeah.
No small business thinks about how do I get my share value higher. Yet they go to the stock market and all they're concerned about is how they get the share market higher.
Well, what an interesting conversation with you, Sean. I really appreciate the time with you here on Inkish TV. You have written a book, you said, and you have your company. What is the company name?
Well, I have a few companies. The one that I would do my M&A work out of is called First Servant Capital. Mm-hmm. And the book that I wrote, which is very germane to this conversation, which is pretty much germane to every M&A conversation, is it's Why Boss. It's on Amazon. You can get it for free, so it's not a plug for cash.
So that's not your retirement security by having a free book on Amazon.
And the irony, I have a couple of printer clients. They're giving me a hard time about not getting it printed again. And I just get the transcripts out. I'm too lazy. But the Why Boss stands for Your Business Ain't Worth Shit. And I wrote this after the 2009 when that expectation gap was so high, and the owners didn't realize what it took to get the value high or marketable. And so I wrote this. And typically what I do is if somebody approaches me as a potential client, I make them read the book first. If they don't read the book, I won't take them on as a client because then we're just going to be fighting.
Kind of makes sense, right?
What's that?
It kind of makes sense, right? That's your due diligence of your customers, right?
Well, a little bit. But you think about what I've learned, especially in this digital, Instagram, Facebook age, is no one has any attention span. So what happens is when you read a book, you can't argue with me at the same time. You have to wait till you finish the book.
Okay, that was the reason. Yeah. I like that a lot.
Right? Like this isn't it's not Moby Dick. There's like 100 pages and it has pictures. So it's not going to take a whole lot out of your day to figure it out. But you understand. A lot of people don't know what EBITDA is from EBIT, from revenue. They don't know how to get a multiplier. They don't know what affects this. But yet they want to sell their business. Yeah. And it's like Pfizer. I'm selling you a vaccine. I have no idea what's in it, but I'm selling it to you, right? Yeah. So that maybe not. You might have to edit that. Might be politically incorrect. But I mean, it's not knowing the components, what create value in your product, is not something anybody would consider be successful long term. Mm-hmm. Everybody knows their product well enough. Well, now your product is your shares. Right? That's your product. That's what you're trying to sell to the market. Yeah. Now you have to understand what goes in and creates value for that product and what makes it marketable for everyone to buy. That's all I'm telling. That's all I'm asking. In the book, it sort of guides you through that process. And it's a very easy to read book. It's a edutainment type thing. It really tells a lot about me as a person and who you're going to be dealing with as much as the technical. And that's sort of what I give. And when someone can go through the book and they understand it, we become very successful partners in the process. This book, it does not need to be read by anyone who's done 2 or 3 transactions before. They already got it. They already know.
Yeah. This is for the new beginners.
Yeah, for the guys that understand the terminology about discounted cash flow and present value and marketability, and I give a couple anecdotes of the Heidelberg Press guy, just as an example. Is we went to buy his company just for the machine, and it was, let's say it was $1 million. He made no money. It literally made no money. He was just sitting there doing nothing. But it literally took us a year to wait to Heidelberg to deliver us a new one, and we had ready business. So we were willing to pay over the market price for this machine. And he said to me, when I offered $1 million for it, he says, well, you're not going to steal my company. And I said, what do you mean steal your company? And I was with this gentleman for 30 days. We never had a joke once. And anyone from this interview knows, I like to laugh and smile. What happened was that he said that I was stealing the business from him, because when he bought the business 35 years ago, the person who sold it said, you'll be able to sell this and retire. And so a week before our offer, he went to his financial planner and said, I need $5 million to retire. Therefore, my business is worth $5 million.
Yeah.
It didn't make any money. But there are a lot of people, like that's a dream case. I don't think anyone is sort of that clueless or dense. But there is a degree of people with a lot of confirmation bias, a lot of lacking awareness of process, valuation, and how things work, and just going on hopes and dreams of what they want to be true and not what is true. And that's a recipe for disaster for a lot of people. And I've run into a lot, and why I do a small business now as opposed to the earlier career, is that there's a lot of guys that remind me of my dad, who was a small businessman and didn't cash out as high as he could have. And I was just a young kid when he did. But I see some of these guys now,
basically.
Well, yeah, and it's sort of what pushed me into sort of the area that I was in. Not that I wasn't interested in it already. I've started businesses and sold them since I was 16 years old. The fact of the matter is, when a 65-year-old thinks he's going to sell, can't sell, and his whole future and retirement is completely different than what he expected, because he just has to fold up his company.
Yeah,
that is tragic.
Yeah,
and it's happening. It's happening all the time. Over here, it's happening all the time. These guys are working at 75, 80 years old. They have no retirement. They can't afford to retire.
Yeah, it's definitely the same. Definitely the same here in Europe, and I think that you're totally right that it's a tragic. And I think that, I can't help think about, because sometimes we when we talk to printers, I mean, maybe not so much more, but in the past, when they were doing like a corporate brochure, they always showed their machine as that was the asset of the company. They totally forgot that the asset was the people and the value the printed product gave to their customers, right? And that is actually one of the reasons why we want English to be a kind of a learning platform for people to understand that the time is changing and the measures are changing, and I remember when I was working in a printing company 20 years ago, my boss, he took over the business from his father. And I think that his biggest wish in that little city we came from was basically to have a statue of his father on the city square hall, because he used to be a big man in the city, right? And that is very picturizing how I think many people in the printing industry, especially before the internet came along, were very important part of the communication and the mass distribution. And today, that has simply changed completely.
Yeah.
So fantastic, Sean. Very, very last note. How are you going to celebrate Christmas in your family?
Well, I don't know if the government's listening and stuff like that. We're on a lockdown here, so we're restricted to how many people can go. Okay. But my Christmas gift, I'll just leave it on this note. My Christmas gift is paying all the fines and penalties if they ensue on Christmas Day. I'm not saying going to break the law, but it's on me if we, because it's really tough. In my family, I have 4 children, and my family, just the blood part of our family, can rise to 20 people. And to say you can only have 5 people in your
okay.
Yeah, it's it's
I can tell you tough. I can tell you one thing, that in Denmark we are allowed to be 10, and we are also breaking the law, because tomorrow we are 11.
Yeah, it happens, and we're going to fight it, and we'll win, because it's against our Charter of Rights and Freedoms for the government to do this. There's no, but we have a very liberal. I live in Ontario, and the outer regions are all more conservative, and the city is more liberal. So they've locked down the cities, but they didn't lock down the regions because the regions aren't going to listen anyway. Okay. Whatever. What are you going to do? Right? Because up there in the smaller communities, the police live in that community. You think they're going to go ticket their friend on Christmas? It's going to happen. No. Right? So they say, okay, our lockdown starts on the 26th for you guys, but for the people in Toronto, it's the 24th. Okay. And I don't know what's going to happen.
Okay. But you will see some people, and you will have some good food, and you will sing some hymns, and basically have a holiday season with gifts and everything, just a pleasure, right?
Oh my goodness, we got 3 birthdays and Christmas.
Okay, then at least you don't have to see them other times of the year, right?
Well, it's still it's one continuous 3-day party for us. In our world on the 25th, 26th, 27th. So, I don't know. I think we're just going to roll like we usually roll. People who want to come can come, and if they don't want to come, they don't come, and we'll just deal with that as the situation presents itself. But yeah, I think we're just going to do what the family wants to do, and we'll follow the government in the new year.
Okay. Fantastic. Yeah. Once again, thank you very much for your time, and I wish you and your large family a very happy holiday season, and I wish you all the best, and I hope that that we will talk again at some other level, at some other point. It has been fun and educating, yes, so thank you very much.
Thank you so much for the opportunity. It was a lot of fun.
Yeah, I think it was fun, wasn't it?
I love it. It was good. You're a good interviewer. I appreciate it. You make me feel very comfortable.
Thank you very much. Take care.
Okay. Have a great day.
Yeah, you too.
Christmas. Bye-bye.